Hello everyone, welcome to EduTap and welcome to today's Finance 360-degree session where we are going to discuss the half-yearly report on the management of foreign exchange reserves that is released by the Reserve Bank of India. Okay, so first of all, I hope I'm clearly audible and visible, and this is a very important report of the Reserve Bank of India because from this report, previously also we have seen the questions in the phase 1 of the RBI Grade B examination, okay, as well as the questions can also come in the phase 2. As various important data has been discussed in this report and this is released just before the examination, so this become very important. Okay, so this is a very important report. So now today we are going to have a detailed discussion about this report, the important data point that has been given in the report, various facts that are important from the examination point of view that has been provided in this report. Okay, and the previously also the questions have come from this report in the RBI Grade B examination, so this becomes very important. So give me a thumbs up. I hope I'm clearly visible and the audio is also clear. Chalo. So now the half-yearly report on management of foreign exchange reserves, this is released for the period of October to 2025 to March 2026. Okay, so the data has been released for the end of March 2026. Now, this report is released by the Department of External Investments and Operations of the Reserve Bank of India. So, RBI has released this report. Okay. Now, let's start with the report, and this is the report that we are going to discuss. So, first of all, the RBI publishes a report on the management of India's foreign exchange reserves twice every year. So, I hope first of all you know that the Reserve Bank of India is the monetary authority that manages the foreign exchange reserves. Now, these foreign exchange reserves can be used for paying for the imports or paying the dollars for the imports or paying for the interest on the loans that we have taken and such. So the foreign exchange reserves, they are the reserves that are held by the Reserve Bank of India that can help sustain the imports of our country, that can help sustain the payments of our country. Okay, so that is the idea. So RBI publishes a report on the management of India's foreign exchange reserves twice every year. Now these reports are prepared half yearly with reference to the position as at the end of March and as at the end of September each year. So recent report has been released for the end of March 2026, that is for the recent time period. Okay, in February 2004, the RBI initiated the practice of compiling the half-yearly reports and making them public to promote greater transparency and enhance the disclosure in the management of the country's foreign exchange reserves, so that the public can be made aware that how the RBI is managing the foreign exchange reserves. So since February 2004, the initiative was taken. So in February 2004, the RBI initiated the practice of compiling the half-yearly reports and making them public to promote greater transparency. Okay. Now the present report is the 46th in the series. I hope this is clearly visible. The present report is the 46th in the series, and this is with reference to the position as at the end of March 2026. Okay, so the present report, it provides the data as at the end of March 2026. Now the report has two parts. So the whole report is divided into two parts. The part 1 contains the developments regarding the movement of the foreign exchange reserves. The movement of the foreign exchange reserves. The information on the external liabilities, how much liabilities do we have with the other countries, and the external assets, like how much assets do we have in the other countries also. Adequacy of reserves. The reserves, are they adequate during the half year under review? So till March, at the end of March 2026, we will see that what is the movement of foreign exchange reserves, they have increased or decreased, the external liabilities against the external assets, and the adequacy of reserves. All of this we are going to discuss in the part 1. Part 2 explains the objectives of reserve management, legal provisions, risk management practices, and the transparency and disclosure measures followed by the RBI in managing the reserves. So basically we are going to discuss both the parts and you will understand that what is in which part. Okay. Chalo. Now key highlights of the report. So additional questions I will take at the end of the session. For now, just focus on the report. So key highlights of the report. Movement of foreign exchange reserves. So the foreign exchange reserves, they have decreased from 700 billion to 691.11 billion. Okay, so the foreign exchange reserves have decreased from US dollar 700.09 billion as at the end of September 2025 to US dollar 691 billion as at the end of March 2026. So there is the decrease in the foreign exchange reserves. You can understand that the foreign exchange reserves, they were also used, like the dollars, they were sold in the market, or they were provided in the market, so that, see, the price of dollars was increasing very rapidly. Okay, the dollar was appreciating and the rupee was depreciating rapidly. So what the RBI did, the Reserve Bank of India, from the foreign exchange reserves, RBI released the dollars. RBI supplied the dollars. With the supply of dollars, with the higher supply of dollars, the price of dollars will reduce and the appreciation of dollars will reduce. Okay, the appreciation of dollars will stop or it will reduce. So RBI supplied the dollars, that means RBI sold the dollars from its foreign exchange reserves, and that's why also we can see that the foreign exchange reserves have decreased from September 2025 to till March 2026. There is the decrease in the foreign exchange reserves. Now, in the foreign exchange reserves, what are the components? So, the foreign exchange reserves, basically, the foreign exchange reserves, it consists of different components. The foreign currency asset. Foreign currency asset, basically, in the foreign exchange reserves, the RBI is holding the foreign currency, the dollars, the pound sterling, the euro, as well as the Japanese yen and such. So in the foreign exchange reserves, there is the foreign currency asset, the foreign currency that the RBI is holding, the dollars, the euro, pound sterling, Japanese yen, and the other currencies. There is also gold that is held in the foreign exchange reserves. Now, how much gold is held? What is the percentage of the gold that is held in the foreign exchange reserves? All of this we will discuss. But another thing that is kept in the foreign exchange reserve, anyone know that what are the other things that are kept in the foreign exchange reserves? The SDRs. That is the special drawing right. Now, I hope you know that the member countries of the IMF, so India is a member country of IMF. So all the member countries of IMF, we have to provide quota to the IMF. Like if you are joining a gym, you have to provide some subscription to the gym, right? Similarly, the member countries of the IMF, they have to provide quota to the IMF. Okay, on the basis of the GDP or on the basis of the size of the economy, we have to provide the quota to the IMF. Now, how much quota we are providing to the IMF? On the basis of that, IMF provide the special drawing rights to India, okay, or to the other countries. So on the basis of how much quota we are providing to the IMF, on the basis of that, the SDRs are provided to the different countries. There is also, under the foreign exchange reserves, there is also the reserve tranche position. Now I have told you that India, being a member country of the IMF, we have to provide quota to the IMF. Now, a part of the quota we are providing in the rupees and another part of the quota we are providing in the foreign currencies, or the strong currencies, we can say. Strong currencies, stable currencies like the dollars, euro, and such. Now, the quota that we are providing in the strong currencies, the quota that we are providing in the hard currencies, these are also known as the hard currencies like the dollars, euro, pound sterling, and such. So, the quota that we are providing in the strong currencies, a part of that is reserved for India only, so that it can be used when there is requirement. Okay, this is known as the reserve tranche position. Now, India, the quota that we are providing to the IMF, on the basis of the quota, the SDR allocation is decided, that how much SDRs, how much special drawing rights will be provided to India. Now, out of the quota, a part of the quota is in the domestic currency, another part of the quota is in the foreign currencies. So, the part of the quota that is in the foreign currency, a part of that is reserved for the country only, that is known as reserve tranche position. Now, in the foreign exchange reserves, now I have told you that there is the foreign currency asset. So, the foreign exchange reserves, the forex reserves, they constitute the foreign currency asset, the gold, the special drawing right, and the reserve tranche position. Okay. Now, in the foreign exchange reserves, the highest portion is the foreign currency asset. Then there is the gold. Then there is the the highest portion is of the foreign currency asset. Then there is the gold. After that, there is the special drawing rights. Okay. Then there is the reserve tranche position. So this is the basic idea that the largest portion in the foreign exchange reserves is of the foreign currency asset. Any confusion, anyone? Mansa and everyone. Okay. You have seen that 9 hours. Why are you doing those 9 hours together? Have you not seen the previous sessions? See, the Finance 360 sessions are taken every Tuesday, Thursday and Saturday. So if you have seen those sessions, that means you do not have to see this 9-hour session. This is just a compilation, right? This is not a single session. This is the compilation of the different sessions. So on the regular, that's why I say that see the sessions on the regular basis so that it doesn't become very bulky for you. So don't see that 9-hour session. I hope you have already seen the sessions of the Finance 360 degree on Tuesday, Thursday and Saturday. So focus on the session right now so that you will not have to see the bulky session. Okay? Chalo. Now, foreign currency assets are actually held in multiple currencies like the US dollar. Here, you don't have to remember that what is the amount for foreign currency asset, what is the amount for gold, SDRs and reserve tranche position. Remember that what are the parts of the foreign exchange reserves as well as the highest component of the foreign exchange reserves is the foreign currency asset. Now, the foreign currency asset are actually held in multiple currencies like I've told you, the dollars, euro, pound sterling, Japanese yen, etc. And they are valued. All of these currencies are then valued in terms of dollars. Okay. The following are excluded while calculating FCA. So remember that what is excluded while calculating the FCA. So while calculating the foreign currency asset, the investment in bonds issued by India Infrastructure Finance Company, United Kingdom, this has to be excluded. So when the foreign currency assets are being calculated, so what do we have to exclude? We have to exclude the investment that is happening in the bonds issued by the India Infrastructure Finance Company. As well as while we are calculating the FCA, the SDR holdings have to be excluded because the SDR holdings are included under the SDR. When we are calculating the FCA, the amount lent, if the RBI has lent the amount, has given the loan under the shark currency swap arrangements or under the ACU currency swap arrangement. So if the loans have been given under the different arrangements, if the loans have been given by the RBI under the different arrangements, so they also, now these loans that are given in dollars or that are given in euro, so these loans have to be excluded from the foreign currency asset. So what is shark like currency swap arrangement, that we will discuss later on. But just remember that whatever loan has been given by the RBI under the shark currency swap arrangement or under the ACU currency swap arrangement, so these kind of loans have to be excluded from the FCA because this money has been given out. RBI's contribution to funding of Nexus global payments. So to make the global payments faster, there is the Nexus global payment initiative that is going on, and the RBI is funding this initiative. RBI is one of the entity that is funding the Nexus global payments. Okay, so RBI's contribution to the funding of Nexus global payments, this has to be excluded from the FCA. Very important to remember. Now, accretion to foreign exchange reserves. Any confusion till now? Accretion to foreign exchange reserves. Okay. So how the foreign exchange reserves, what is the increase or decrease that has happened in the foreign exchange reserves? So what is the change in the foreign exchange reserves that we have to understand? And to understand that, first let's understand the balance of payment. So in the balance of payment, there is the current account and there is the capital account. Okay. So in the current account, there is the trade in goods. See, balance of payment, it records all the transactions that we are doing with the other countries. So the balance of payment records all the transactions that India is doing with the other countries. Okay. Now in the current account, we have the trade in goods, trade in services and transfer payments. Okay. In the capital account, the investment that we are getting or the investment that we are doing in the other countries, like the portfolio investment, the investment in the shares, bonds, in the financial market, the foreign direct investment. So all the investment that we are getting or that we are doing in the other countries. In the capital account, there is also the borrowings. That is included the external commercial borrowings that we are doing from the other countries, or the lending that we are doing to the other countries, as well as in the capital account there is also the external assistance that is included and the external borrowing that is included. Okay, now the current account is in deficit. The current account is in deficit. Deficit means that we are paying more than what we are receiving. But the deficit, here you can see the deficit has reduced. The deficit has reduced and the condition of our country has improved. The condition of our country has improved. The deficit has reduced from $36.7 billion to $30.2 billion. So this is the idea about the current account, that the deficit has reduced. But in the capital account, the problem is there. The capital account was in surplus. In 2024, April to December 2024, there was surplus in capital account. But now there is a deficit in the capital account. So here you can see the condition of the balance of payment of India, that before we had higher deficit in the current account, but the deficit has reduced. The current account deficit has reduced and the condition of our country has improved. Okay, in the capital account, the surplus has converted into deficit. So this is a problem. So now current account, on the basis of the balance of payment, current account is in the deficit of $30.2 billion. Okay, $30.2 billion. This is the deficit. While the capital account is in the deficit of $0.6 billion. So that means on the basis of balance of payment, there is deficit that is happening. There is deficit that is happening. That means we are paying more than what we are getting. And how are we paying more? We are paying more than what we are getting. So how we are paying more? By using our foreign exchange reserves. So that is the idea. Okay. We have to pay more than what we are getting. So this is the idea. So on the balance of payment basis, from April to December 2025, there is the decrease in the foreign exchange reserves by $30.8 billion. That you can see that the current account is in deficit of $30.2 billion and the capital account is in deficit of $0.6 billion. So that means $30.8 billion. This is the decrease in the foreign exchange reserves. Any confusion? This is the decrease in the foreign exchange reserves. Remember that on the balance of payment basis, the foreign exchange reserves decreased by $30.8 billion. This is the decrease in the foreign exchange reserves. Okay. So the foreign exchange reserves from April to December 2025, the foreign exchange reserves decreased by $30.8 billion on the balance of payment basis. But see, in the foreign exchange reserves, the RBI hold gold. And from 2024 to 2025, can we say that there is huge increase that has happened in the gold value? So there is valuation gain that the RBI has got, because in the foreign exchange reserves, the RBI is holding the gold also. So the gold value has increased. Because of the increase in the gold value and the depreciation. See, what has happened, that the dollar has depreciated against the other hard currencies, against the other strong currencies like the euro or pound sterling and the Japanese yen. Because of the depreciation of dollars, the other currencies have become stronger. And in the foreign exchange reserves, the RBI is holding the dollars, but RBI is also holding the other currencies, and the other currencies, they have become more stronger, and that's why the foreign exchange reserves have improved with the depreciation of dollars, because we are holding the dollars in a chunk, but we are also holding the other currencies like the euro, the pound sterling, the Japanese yen in big chunks also. So if the dollars has appreciated against these currencies, the other currencies have appreciated, they have become stronger. So the foreign exchange reserves. So valuation gain basically tells us that in the foreign exchange reserves, the gold value has increased, due to which the foreign exchange reserves have increased because the gold value has increased. Okay, as well as the dollars has depreciated, due to which the other currencies have become stronger and the foreign exchange reserves valuation has improved. Other than that, the bond yield is decreasing. If the bond yield is decreasing, that means yield and the prices, they have inverse relationship. If yield is decreasing, the bond prices are increasing. Now the RBI has already invested in various bonds. So the bonds that the RBI is holding, the bond prices are increasing. So in that way also the foreign exchange reserves are improving. Okay, so basically the valuation gain has come in the foreign exchange reserves. So on the balance of payment basis, the foreign exchange reserves have decreased by $30.8 billion. But because of the valuation gain of $50.2 billion, there is the valuation gain of $50.2 billion. This is the valuation gain from the April to December 2025. So valuation gain is of $50.2 billion. So in total, the foreign exchange reserves have actually increased by $19.4 billion. So including the valuation effect, including the valuation gain, the foreign exchange reserves have increased by $19.4 billion. So what you have to remember is that on the balance of payment basis, the foreign exchange reserves have decreased by $30.8 billion. $30.8 billion. And this article was also released in March, but we didn't include it in March because we knew that the report will again include it. Okay, so in March also this topic was in news, and in April also this is in news. Okay, the same things were also provided in March in a press release in March of the Reserve Bank of India. Again, this is in news in April, so it becomes important. So on the balance of payment basis, the foreign exchange reserves have decreased by $30.8 billion. But because of the valuation gain, because of the gold prices increasing, depreciation of dollars against the other hard currencies, and the decrease in the bond yield and the increase in the bond prices, the valuation gain is of $50.4 billion, due to which there is the $50.2 billion, $50.2 billion. Valuation gain is of $50.2 billion. Okay, now due to this, the foreign exchange reserves decreased $30.8 billion. Foreign exchange reserves increased by $50.2 billion. So in total, the net effect on the foreign exchange reserves is $19.4 billion. So the foreign exchange reserves have improved by $19.4 billion from April to December 2025. This is the condition of the foreign exchange reserves. From the April to December 2025, the foreign exchange reserves have increased on including the valuation effect, when we include the valuation effect. Any confusion? I hope this is very much clear that on the balance of payment basis, the foreign exchange reserves decreased, but on the valuation basis, the foreign exchange reserves increased. So in nominal terms, including the valuation effect, the net effect is increase of foreign exchange reserves by $19.4 billion. And why the valuation gain happened? Because of the increase in gold prices, because of depreciation of dollars against the other major currencies like the euro, pound sterling, and such. Lower bond yields. With lower bond yield, there is higher bond prices, and the RBI has invested already in the bonds, so RBI is getting the higher bond prices now. Chalo. What is the valuation gain? If I ask you a question that what is the valuation gain in the foreign exchange reserves? So it is $50.2 billion. Remember this. And what is the effect on the foreign exchange reserves? What is the foreign exchange reserves including the valuation gain? What is the effect on the foreign exchange reserves including the valuation gain from April to December 2025? So basically, the foreign exchange reserves have increased by $19.4 billion. So this is something that you have to keep in mind, that you cannot forget. Okay. Now coming to the forward outstanding. Coming to the next point. So forward outstanding is basically at end March 2026, the net forward asset payable position of the RBI stood at $103.06 billion. So basically, net forward asset is the foreign currency asset. So RBI has the position where the RBI has promised to pay the foreign currency asset in the future. So this reflects RBI's net payable position. RBI has to pay the dollars in the future. Okay, under the forward contracts. The forward contracts are basically the derivative contracts that derive their value from some underlying asset. So basically, RBI has made the contract that in the future, or in the future date, RBI is going to pay the dollars, okay, and take back the rupees. Take the rupees and pay the dollars. So the net forward asset payable by the RBI is at US dollar 103.06 billion. So this is the forward outstanding of the RBI. RBI has to pay $103 billion in the future, in a future date. So this should not be treated as the immediate liability because this is the future liability on the RBI. Okay. Now coming to the external liabilities against the external exchange reserves or the external assets basically. So external liabilities basically the different entities. See, external assets are what? Let's say State Bank of India has opened a branch in US. Now this is a liability for our country or asset for our country? Is this a liability for our country or asset for our country? Anyone? If the State Bank of India has opened a new branch in US, this is basically asset. We have done direct investment, or let's say the XYZ person of India, they are investing in the shares in UK. So that is portfolio investment. We are investing in other currencies due to which we are getting the external assets. Due to which we are getting the external assets. So the total external assets have increased. They have increased from $1070 billion to $1198 billion. So the total external assets, the direct investment that we have done in the other countries, the portfolio investment, the shares, the bonds, the derivatives that we have bought in the other countries, other investment is basically the credit that we have given, the trade credits that we have given and such. So other investment that we have done in the other countries and the foreign exchange reserves that we have. All of this constitutes the total external assets that we have. Okay, so total external assets have increased from $1,070 billion to $1,198 billion. But now there is also the external liabilities. External liabilities basically, try to understand this, that external liability, this is the liability. Let's say the foreign investors, they are investing in the Indian financial market. They are investing in shares, they are investing in bonds, they are investing in the derivatives in our country. Now when the foreign investors want, we have to return the money. Foreign investors, they are also like foreigners, they are also depositing their money in India. So this is a liability on India that we have to return the money whenever the foreigners want. So when the foreign investors, they are doing the portfolio investment, we will have to return the money in the future. So this is a liability. When the foreigners are depositing their money in our country, this is a liability because we will have to return the money in the future. When the foreign investors, they are investing, they are opening their subsidiaries or branches in our country. So this is also a liability that in the future they might close down their business and we will have to return the money to them on the basis of how much asset they have in India. So this is the liability, the direct investment that the foreigners are doing, in India. This is a liability because in the future we will have to return the money, or we might have to return the money. Portfolio investment that the foreigners have done in India, this is also a liability because in the future we might have to return the money. The foreigners might sell their shares in the market or sell their bonds in the market. They will want their money back. Other investment is basically the deposits, the non-resident deposits or the foreigner deposits. The foreigners are depositing their money in India. This is also a liability that we will have to return in the future. So the total external liabilities have increased from $1,434 billion to $1,458 billion. Now you can understand that the increase in the external assets is higher than the increase in the external liabilities. So basically the external liabilities are higher than the external assets. But the increase that we are seeing, the end December 2024 to end December 2025, the increase that we are seeing is higher in the external assets, due to which the negative net international investment position has basically improved, we can say, because before we had more liabilities, external liabilities against the external assets, but now we have higher external liabilities against the external assets, but the value has decreased to some extent. This is the basic idea. Any confusion? So basically you have to remember that the external assets, they have increased. The external assets, they have increased, and they have increased by a higher margin than the increase in the external liabilities. But the external liabilities, the complete amount or the total amount of external liabilities is higher, and that's why the net position is in negative. is in negative of $260 billion, but still the net position has improved because the deficit has reduced to some extent, because before the deficit was $363 billion, but now the deficit is only $260 billion. Okay, any confusion? Chalo. Now coming to the adequacy of foreign exchange reserves, this is very, very important. From this particular part, two questions have been seen in the 2023, 2024, 2025 examinations. So there was a question from this part, as well as there was a question from this part also. So this particular table is very important from the examination perspective. Okay, if the updated data comes, then this will lose its importance, but for now this is the most updated data that we have, that the RBI has released, so this data is important. Okay, now first of all, foreign exchange reserves as cover of imports. So right now RBI has nearly $691 billion of foreign exchange reserves. So they are able to cover the imports of 10.8 months. So for the 10.8 months of imports, the reserves are sufficient. Okay, so as at the end of December 2025, the March 2026 data is not available. Wherever the data is given for December 2025, basically remember this, that the data is not available for the March 2026. That's why the December data has been given. That is the most recent data that is available. So at the end of at the end of September 2025, there was the coverage of 11.3 months, but now the coverage has decreased because the reserves have depleted. The foreign exchange reserves have depleted, and that's why the coverage has reduced to 10.8 months. Now the short-term debt on the original maturity basis to reserves. So short-term debt to reserves ratio, or the percentage, has increased to 21.9%. So short-term debt as a percentage of reserves is 21.9%. Okay, volatile capital flows as a percentage of reserves. So this has also increased. The volatile capital flows basically include the portfolio inflows. So portfolio investment is happening, but that is very volatile, because today the investors are investing, the foreign investors are investing in the shares, in the bonds. Tomorrow they might take away their money. Okay, so there is volatile capital flows that we get the inflow of the portfolio investment, short-term debt also, that has to be returned in the short term, in a short period of time. So basically volatile capital flows as a percentage of reserves have increased to 69.1%. This is the idea. So the foreign exchange reserves as a cover of imports have decreased, the short-term debt to reserves have increased, and volatile capital flows as a percentage of reserves have also increased. Coming to the management of gold reserves, as at the end of March 2026, the RBI held 880.52 metric tons of gold, of which 680 metric tons of gold is held domestically, while 197.67 metric tons of gold is kept in the safe custody with the Bank of England and the Bank of International Settlements. From this point also, there was a previous year question. In 2024, I think the question has come in the phase 1 from this particular point, that where do we keep the gold in the safe custody outside India? So we keep it in Bank of England and Bank for International Settlement. Remember this, okay? So this is the idea, that a part of the gold, major part of the gold is held domestically, but a part of the gold is also held in safe custody with the Bank of England and Bank for International Settlement. 2.80, that means a very small part of the gold is held in the form of gold deposits. In value terms, the share of gold in the total foreign exchange reserves, the share of gold has increased from 13.92% at the end of September 2025 to 16.70% at the end of March 2026. So from the September 2025 to March 2026, there is the increase in the share of gold in the total foreign exchange reserves to 16.7%. Okay, investment pattern of foreign currency asset. Now we have seen that in the foreign exchange reserves, the highest component is what? In the foreign exchange reserves, the highest component is of what? The highest component is of what? In the foreign exchange reserves, the highest component is of gold, SDRs, or the reserve transfer position or the foreign currency asset. We have just discussed it in today's session. Foreign currency asset. Very good. In the foreign exchange reserves, the highest component is of the foreign currency asset. Now, RBI is holding all the dollars, euro, pound sterling, Japanese yen, and the other currencies with itself. But we will be making losses now, because if billions of dollars are being kept with the RBI in its vault, that means RBI is not earning anything on it. RBI is not earning any interest, any returns on it. So actually, RBI do not keep all the RBI do not keep all the foreign currency asset with itself. The foreign currency asset, the dollars, euro, pound sterling, Japanese yen, they are invested. Okay. So basically, investment pattern of the foreign currency assets, the foreign currency asset comprise multi-currency asset. The dollars, euro, pound sterling, the RBI is also holding Japanese yen and the other currencies also. So FCA comprises of multiple currencies that are held by the RBI. Now the RBI is not holding all of the foreign currency asset. The RBI invests the foreign currency asset as per the best international practices. Okay. Now, the foreign currency asset is invested where? The money is invested where? Yes. So, investment pattern, see. The foreign currency assets, they are invested in the securities. Securities is what? Securities are basically the sovereign bonds, the government bonds. So, government bonds of the different countries, they are the most trusted instrument. Okay. This government securities that is released by the Reserve Bank of India on behalf of Government of India, they are safe. They are considered safe securities because they are backed by the Government of India. The Government of India will have to return the money to the investors. So they are the safe securities. Similarly, the other countries also, the government of other countries also, the government of US, the government of UK, the government of European countries, they also release their sovereign bonds that is backed by the government of their countries. So that is the idea, that securities, especially the sovereign bonds or the bonds backed by the government of the different countries, they are the most secure securities, and the RBI invest a huge part in these securities. Here you can see that the foreign currency asset, the highest investment that happens from the foreign currency asset is in the securities, especially the sovereign bonds or the bonds backed by the government. Okay. Now the FCA, a part of the FCA, a part of the money is also deposited with the other central banks and the Bank for International Settlement, and the least a part of the foreign currency asset is also deposited with a commercial bank overseas. Here the numbers are not important, but the percentages are important, and especially the foreign currency asset. The foreign currency asset is invested majorly in the securities. 84.31% of the FCA that is invested in the securities. Okay, and securities majorly the sovereign bonds or the bonds backed by the government. Any confusion? Remember the percentages from highest to lowest. Okay. So in the foreign exchange reserves, in the forex reserves, $552.28 billion is in the foreign currency asset. Okay. Which is invested as well as it is deposited so that the RBI can earn the returns. Now coming to the next part, that is financial transaction plan of the IMF. See, basically the countries, member countries, they are providing quota to the IMF. Now, what is the use of this quota? The IMF can use the quota to provide the loans to the different countries that are in the requirement. So there is a disaster that happens in, let's say, Mauritius, and so the money is provided to Mauritius or Maldives or any Turkey and such. So basically, the member countries, they provide the quota. So basically, the member countries, they provide the quota to the IMF. And IMF uses this quota to lend to the other countries. Okay. Now it is said the financial transaction plan basically states that, let's say, India is providing quota to the IMF. Now IMF is using this quota to lend to the other nations. So India will become the creditor nation. India will become the creditor nation that is actually providing the money, and the other nation, let's say Maldives, that is taking the loan from the IMF, is becoming the borrower nation. I hope this is making sense, that under the financial transaction plan, how the things work is that India is providing quota to the IMF. That quota can be used to lend to the other countries. But if the quota of India is being used to lend to other countries, so India is considered as a creditor nation and the other country is considered as the borrowing nation. Okay. So during the half year under review, that is from the October 2025 to March, that is at the end of March 2026, during the half year under review, there were three purchase transactions aggregating. Three purchase transactions means three loan transactions totaling US dollar 415.86 million, and four repurchase transaction means return of loan aggregating US dollar 223.91 million under the financial transaction plan of the IMF. The FTP is a mechanism through which the IMF finances its lending, because it is basically the quota that is used by the IMF to lend, okay, and repayment operations. So basically, this is the idea that I have tried to explain you. It is a big mechanism that you do not have to focus on, but remember that under the financial transaction plan of the IMF during the half year under review, that is at the end of March 2026, there were three purchase transactions from the quota of the IMF and four repurchase transactions. Purchase transactions are basically the loan that the IMF has given from the Indian funds, and repurchase transactions are basically the return of the money that we have got in our quota back. Okay, this is the idea. Now, investments under new arrangement to borrow. Now, this is different. This is the new arrangement to borrow. It is a multilateral borrowing agreement between IMF and 38 member countries that allows the IMF to borrow from those members. So basically, let's say the IMF does not have enough of the quota to keep on lending to the different countries. So quota is insufficient and IMF has used majority of quota to lend. But IMF still needs more money. So if IMF still needs more money, so for that there is the new arrangement to borrow, that IMF can borrow from certain countries. So IMF also has an agreement with India that if IMF needs, IMF can borrow from India also. Okay. So India's commitment under the IMF's new arrangement to borrow was last raised to SDR 8,881 million SDRs from January 1, 2021. So remember that this is the arrangement between India and IMF, that if IMF does not have enough of the quota resources, and if IMF want, the India will lend the money to IMF. And how much India will lend? That is up to SDR 8,881 million. Okay. Now RBI has till now nil subscription under the new arrangement to borrow. That means till now, by the end of March 2026, the IMF have not taken the loan from India under the new arrangement to borrow. Any confusion? So till now, RBI has nil subscription. RBI has not given any money to the IMF under the new arrangement to borrow because it was not required by the IMF. Next, coming to the shark swap arrangement. So basically, first let's understand the shark currency swap framework. Then we will understand that what the report has said about the arrangement. Okay. So first of all, the Reserve Bank of India, in consultation with the Government of India, decided to put a framework for the currency swap. Basically, under the currency swap framework, what happens that there are the shark nations. Okay, South Asian Association of Regional Cooperation. So under the shark, there is Pakistan, there is Sri Lanka, Bhutan, Nepal. So there are various South Asian nations that are the part of the shark. Okay. Now, what happens that these nations, let's say Bangladesh, Afghanistan, Sri Lanka, Nepal, Bhutan, if they require money, let's say now Bangladesh and India relationship are not very good, but let's say the shark nations, any of the nation that requires rupee to settle the transactions with India, or these nations are in the crisis, they need to settle the transaction with the different countries, so they need dollars or they need the euro. So India has said that India is ready to help the shark nations because India is a part of this regional cooperation. So India is ready to help the nearby neighboring nations. So this is the swap transaction, that these nations will provide their local currency and India will provide them the dollars, rupees or the euro, whatever they require. Okay. And after, like, let's say 6-month time period, they will return the dollars that we have lent to them with some interest, and we will return the local currency to them. Okay, so this is the swap arrangement, that they are giving their local currencies and taking the dollars from us. After 6 months, they will return the dollars with the interest, and we will return the local currency to them. So this is the currency swap arrangement or framework. This is for the period of 2024 to 2027, and the Shark currency swap facility came into operation on November 15, 2012. So we are running this kind of facility since then. Under the framework for the 2024 to 27, a separate INR facility is also provided, where we can provide the rupees to them. So let's say Bhutan requires rupees. So we will provide them the rupees, they will provide us their local currency, and we will provide them the rupees that they need. And after the 6-month time period, or after the time period, they will return the rupees with some interest, and we will return the local currency to them. Okay, so this is the kind of idea. Now, the INR swap window has been introduced with various concessions. Various concessions are being provided at the interest rate. That's why it is beneficial to take the facility under the Shark currency swap arrangement. Okay, the total corpus of the rupee support is 250 billion rupees. The RBI will continue to offer swap arrangements in US dollars and euro also under a separate dollar euro swap window with an overall corpus of $2 billion. So for the rupees, the corpus is 250 billion rupees, but for the dollars and euro, the total corpus is $2 billion that you have to keep in mind. And this currency swap facility is available for the Shark member countries that you need to keep in mind. Okay, so under the revised Shark currency swap framework for the 2024-27, the RBI has signed bilateral currency swap agreements with Bhutan and Maldives monetary authorities. Okay, so with Bhutan and Maldives, the Royal Monetary Authority of Bhutan has availed 15 billion rupees swap on May 26, 2025. Date is not important, May 2025 you can remember, which was rolled over for the second time. That means the time period was increased for the second time on February 26, 2026. The Bhutan has also taken additional 25 billion rupees on March 2026, consisting of 15 billion under the INR swap window and 10 billion under the standby swap arrangement. This swap is for a 6-month period, and usually the swaps are for 6-month time period. Okay, the Maldives Monetary Authority has availed a $400 million of swap facility. That means Maldives have taken the dollars from us and they have given their local currency to us. They will return the money after 6 months. It was said that they will return the money after 6 months. They will return the dollars with some interest after 6 months. But what has happened, that we provided them the swap facility in 2024, and the swap facility was rolled over. That means the extension of time has been taken for the second time for 6 months on October 2025. This is the idea. Any confusion? Now, investment in bonds issued by IFC UK. So RBI has the mandate to invest up to $5 billion in the bonds issued by the India Infrastructure Finance Company UK Limited. So this is the mandate for RBI to invest up to $5 billion in the bonds of this entity. As at the end of March 2026, the amount invested in such bonds is only $400 million. So RBI has only invested this much. Now coming to the part 2. Part 1 is done now. We have discussed various data points under the part 1. Part 2 is just basic functionality of the RBI. So here you just have to keep in mind the basic idea. Okay. So RBI Act of 1934 provides the legal rules for the deployment of reserves in the different foreign currency asset and gold. So basically the RBI Act 1934, it provides the legal framework. It provides the legal framework that how the reserves, the foreign exchange reserves, can be deployed in different foreign currency assets and gold. Law broadly, so under the framework, there are certain rules and regulations that permit the following investment categories. Like the foreign currency asset, they can be invested in securities. Which securities? Okay, so the investment that is happening from the foreign exchange reserves, the investment that is happening, that is under the guidelines that is laid down under the RBI Act of 1934. So foreign exchange reserves, under this there is the foreign currency asset that can be invested, but according to the rules and regulations laid down under the RBI Act of 1934. Okay, so the deposits with central banks and the Bank of International Settlement, that is allowed, that we already have discussed, that from the foreign currency asset the deposits can happen with the other central banks and bank for international settlement. Okay, from the foreign currency asset, the deposits can also happen with the commercial bank overseas. From the foreign currency asset, the major part of the investment is happening in securities. Which kind of securities? Debt instruments, the bonds representing the sovereign bonds or the sovereign guaranteed bonds, sovereign backed bonds, that are the government, sovereign means government backed bonds, with residual maturity for debt papers not exceeding 10 years. This is important to remember, that the FCA can be invested in the securities, but the debt instrument should not be exceeding 10 years. The debt instrument should not be more than for 10 years. Okay. Now, the FCA amount can be invested in other securities also, such as the other instruments or institutions as approved by the Central Board of the Reserve Bank in accordance with the provisions of the Act. Certain types of financial derivatives can also be bought, but only for managing the risk, not for speculative action. So, majorly, the FCA can be used in these three categories. Okay. Now, the broad strategy for managing foreign exchange reserves. So, there is the broad strategy for managing the foreign exchange reserves, including currency composition and investment policy. So, basically, foreign exchange reserves, it consists of FCA, gold. Now, where the foreign currency asset, like how much dollars, how much euro, how much pound sterling, how much yen will be maintained, as well as this amount will be invested where. So, all of this is laid down as per the broad strategy that is decided by the RBI in consultation with the government of India. Where to invest, how much to buy, which currency to buy and such. So the broad strategy is laid down by the RBI in consultation with the government of India. The management of reserves focuses on controlling key risk. Now when the RBI is managing, think about it, that RBI has bought dollars, euro, pound sterling and Japanese yen and the other currencies also. What is the risk here? Is there the credit risk, or is there the market risk, or is there the liquidity risk? What kind of risk, or is there an operational risk? What kind of risk is attached in this case where the RBI has bought the dollars, euro, pound sterling and Japanese yen and the other minor currencies also RBI purchases? So what kind of risk is present? There is no credit risk because RBI has not taken the credit, or RBI has not given the credit and such. The liquidity risk is also not there because these currencies are already very liquid. Operational risk is not there in this case because the RBI is doing the operations as per the broad strategy. Here is the market risk, that what if all the currencies depreciate very fast, or where the investment is huge, that particular currency depreciates very fast, it loses its value. So the foreign exchange reserves, the foreign currency asset, will lose its value. So there is the market risk that is present. Now RBI is providing the RBI is investing in the bonds. So what kind of risk is present here? The market risk, credit risk is present here. That what if the entity defaults? Though the RBI is investing in the secure bonds, but there is slight credit risk, let's say, that is what if the entity defaults. That's why the RBI is not allowed to invest in the bonds of corporates. The RBI is only allowed to invest in the bonds of the sovereign entity or the sovereign backed bonds. So that's why the credit risk is negligible or minimum. Okay, so these are certain kind of risk in the operation or management of the reserves. If RBI is managing the foreign exchange reserves, if RBI is doing the investment from the foreign currency assets, so there are certain risks that are attached. Okay, now gain or losses. See, when RBI is investing in gold, recently the price of gold went from 1,80,000 to 1,50,000. It went down to 1,40,000 also. So can we say that this is loss for RBI? Can we say that this is a loss for RBI? For the time period, for the short run, yes, this will be considered as a loss because RBI has tons, metric tons of gold. Its price was 1,80,000 per 10 grams of the 24 karat gold, let's say. Now the price went down to 1,40,000. So yes, there is the loss, but these losses, are they actual loss? No, they are unrealized. They are unrealized losses. Or if the gain is happening, the gold went from 1,10,000 to 1,80,000. So these gains that are happening, they are also unrealized because RBI is not selling the gold or is not purchasing the gold. Let's say your income is 1 lakh per month. You have the gold jewelry, your mother has the gold jewelry of let's say 10 lakh. Now the price increased to 12 lakh. Is it affecting your regular income? If the price increased to 12 lakh, or let's say if the price decreased to 8 lakh, are you getting affected in any manner? Is your lifestyle getting affected? Is your income, regular income, getting affected if you're not selling the gold? These are only the unrealized gains or unrealized losses that is actually not affecting your standard of living or your income, your regular income. These are unrealized. Similarly, it is said that if the gold price is increasing or decreasing, they should be recorded. The unrealized gains or the unrealized losses, they should be recorded separately. And that's why we have a separate account that is known as currency and gold revaluation account. Similarly, if the foreign exchange, the foreign currencies that the RBI is holding, dollar value is increasing or decreasing, euro value is increasing or decreasing, it doesn't matter, in the sense that these are unrealized gains or unrealized losses. So they are recorded separately in the currency and gold revaluation account, so that this is the separate account which does not affect the normal income and the assets of the RBI. So whenever RBI is reporting about its income and is providing the surplus to the government of India, these unrealized gains, unrealized losses, they are kept separately in a separate account, that is the CGRA account. Okay, so they do not affect the regular income balance sheet and such of the RBI. That is the idea. So gain or losses on the valuation of foreign currency asset. So foreign currency value is increasing or decreasing, gold value is decreasing or increasing due to movements in the exchange rate or price of gold. They are booked, they are written under a balance sheet head named currency and gold revaluation accounts. In the balance sheet, they are reported separately, so they do not affect the regular income of the Reserve Bank of India and the regular balance sheet of the Reserve Bank of India. The balances in the CGRA, they provide a buffer against exchange rate or gold price fluctuations. So there is the separate account for the fluctuations. Okay, this CGRA, this does not affect, like the gold price changes or the foreign currency price changes, they are recorded in the CGRA. So the normal income sources of the RBI is not affected. Okay, let's say that the gold prices decreased massively, the foreign currency prices decreased massively because of a war-like situation. Okay, that is uncertainty. Because of uncertainty, the gold prices has dipped, the foreign currency asset have dipped. Now if they are shown in the normal case of the balance sheet, in the income category, you can understand that the RBI will have to show huge losses that will make the market more volatile, because RBI will be showing such huge losses. RBI will not be able to transfer the surplus to the government of India because there are huge losses. And these are not, like RBI is not selling the gold right now. RBI will sell gold after 5 years, let's say, after 10 years, let's say. So at that time, maybe the gold prices will be very high. So that's why these are not recorded in the normal account. They are reported separately. Similarly, the dated foreign securities. The dated means the long term, 5 years, 10 years, or 5 years, 8 years, 7 years residual maturity. So if the maturity is after 5 years, if the maturity is after 7 years, 8 years, they are the dated foreign securities. They are the dated foreign bonds, that are the long-term bonds. They are valued at market price, and their increase and decrease in the value is also recorded in investment revaluation account. So they are the securities that will be sold in the future. Right now, their increase or decrease in price doesn't matter in the normal case of the RBI. So the investment for the dated foreign securities, there is the investment revaluation account. So remember this, that for the gold and the foreign currency, to record the unrealized gains and losses, to keep it separate, there is the CGRA. And for the long-term foreign securities, the long-term foreign bonds, sovereign bonds, or the sovereign backed bonds that the RBI is purchasing, the debt instruments that the RBI is purchasing, the dated foreign securities, to see the increase and decrease in prices, it is recorded in IRA, so that they do not affect the general income and the reporting of the RBI. Liquidity risk. involves the risk of not being able to sell an instrument or close a position when required. Liquidity risk is when the instruments do not have sufficient liquidity. Okay, so basically, if RBI has invested, let's say if RBI has invested $100 billion in an instrument, now the RBI is not able to sell the instrument because there is not enough liquidity in the market. So that is known as the liquidity risk. The risk of not being able to sell an instrument, or close a position when required without facing a significant cost. So in this case particularly, what is happening, that the RBI is not able to sell the bond or sell the instrument. So this is the liquidity risk, that RBI is not able to sell, or RBI is able to sell at a huge loss. So in this case, there can be liquidity risk, though RBI is investing in such instruments and RBI is diversifying in such a way that there is no liquidity risk or there is minimum liquidity risk. But RBI, the reserves need to have a high level of liquidity at all times in order to be able to meet any unforeseen and emergency needs. So it is basically said that the liquidity risk should not be there, or the reserves need to be maintained in the high liquid instruments so that RBI can easily sell the instruments whenever required and RBI can get the money whenever required. RBI uses SWIFT. We have discussed about the SWIFT. This is the messaging platform to settle the trades. So RBI also uses the SWIFT as a messaging platform to settle its trades and send financial messages to its counterparties, to the other parties, to the other banks, or to the other central banks, custodians of securities. So RBI is not keeping all the securities with itself. There is a custodian of security that keeps the securities safely, that keeps the RBI securities safely, or the securities invested by the RBI. So RBI is investing in multiple securities. RBI is investing in multiple securities, multiple sovereign bonds, multiple bonds backed by the government. So the custodian, there is a custodian of the securities. Okay, so if RBI has to settle some trades, send financial messages to the counterparties, to the custodian of securities, to the other business partners, the messaging platform is SWIFT. Okay, RBI has successfully migrated to SWIFT ISO 20022 standards for both incoming and outgoing messages, so that everything is very efficient and the message exchange messaging formats are being used. These are the best international standard messaging formats. Okay, so that is the idea. So this is in regards to operational risk. The RBI is also mitigating the operational risk by having the best international practices, by doing the best international practices and following the best international standards. Okay, RBI allows the IMF's Spatial Data Dissemination Standards template for publishing detailed foreign exchange reserves data, which is released on a monthly basis to maintain the transparency on the RBI's website. This is it. So we have discussed the part 1. We have also discussed the part 2. Any confusion anyone has? Let me reopen the file so that I can show you that what are the important points that you have to keep in mind. Okay. So see, in the RBI News tab, so you will get this document in the course. You will get this in the course. You will get this report under the RBI News tab, April 2026, 15 to 30th April 2026 part, and the infographics will also be added for the course students. So the team is working on that to also add the infographics so that you can revise in a faster manner. For the YouTube students, let me help you, just give you out the important points. You have to remember that in February 2004, the RBI initiated the practice. Okay, part 1 and part 2 is there. In the part 1, focus on the different components of the foreign exchange reserves, and the highest component or the highest value is in the foreign currency asset. Okay, what comes under the foreign currency asset, what is excluded from the foreign currency asset, this is more important. Okay, you have to remember the data points at least from April to December 2025, the latest data point you have to remember. Okay, these data points you do not have to focus on because the summary is provided here, and the valuation gain is because of increase in gold prices, depreciation of dollars, and lower bond yields. That means higher bond prices. Okay, forward outstanding data is important, $103 billion. Here also just the total external assets, total external liabilities, and the net position. Instead of remembering the data, you can also remember the trend. that okay, there is the increase in the total external assets, increase in the total external liabilities, but the net international investment position is that the liabilities are higher by how much. So this is the data that is very important. Okay, this the whole table is very important, you have to keep this in mind. Management of gold reserves, where the gold reserves are kept. See, Bank of England, the RBI is holding a part of the gold in the Bank of England because it has higher security, the security norms are considered good of the Bank of England. Okay, many different countries, they hold their gold with Bank of England also, and Bank of International Settlement. This is important. Again, the investment where from the foreign currency asset, where the investment is happening, very, very important. Not the data points, but the percentages are very important, especially for the recent period. Okay, financial transaction plan. The data is not very important. Just read it once. That's it. A new arrangement to borrow. Again, in this also there is one data point that you have to keep in mind. Shark swap arrangement. All these data points are not important, but the countries are important. That the shark currency swap framework has been signed with which countries, as well as the recent one is important. That recently with Bhutan, the shark currency swap framework, shark currency swap arrangement has happened, and of how much amount, because this is more recent. Okay, then this is important, of course. And the rest is the law broadly permits the following investment categories from the FCA, so that you have to keep in mind. The rest is theoretical. Okay, the accounts are important, that in which accounts, because this will also be discussed in the annual report. So here the gain or losses from the valuation, you have to remember that there are separate accounts. What is the name of the account, that you have to keep in mind. That's it. Chalo, now let me show you the homework questions that you have to answer in the comment section below. So valuation changes arise due to movements in exchange rates and asset price. So gold prices increased, the dollar value decreased, the bond prices increased. This is the valuation change that is happening. This can significantly influence the foreign exchange reserves. What was the magnitude of the valuation gain recorded during April to December 2025? I hope you will be able to answer the question. Try to answer this. Anyone who can answer this. Here the question is about the valuation gain. What was the magnitude of the valuation gain that was recorded during April to December 2025? So this is the question that you have to answer first. The second question is in front of you. Short-term external debt. Short-term external debt relative to the reserves as a percentage of reserves is an important vulnerability indicator in external sector analysis. What was the ratio of the short-term debt with the original maturity to foreign exchange reserves at the end of December 2025? So this is also important. From this, there was a question that has come in 2023 also. So remember that this is also very important. Okay, next question is this. Read the question very carefully and try to answer this. That with reference to the management of gold reserves and investment practices of the Reserve Bank of India, consider the following statements. A majority of India's gold reserves is held domestically, while a portion is kept in safe custody with institutions such as Bank of England and Bank for International Settlement. The share of gold in total foreign exchange reserves declined between end September 2025 and end March 2026 due to diversification. So think about it, that the share of gold, has it increased or decreased? What was the percentage? The RBI is permitted to invest up to USD 5 billion in bonds issued by IIFL. But at the end of March 2026, the amount invested was only 400 million. So which of the above statements is or are correct, that you have to inform. Okay, so these are the questions. The first question is about the valuation change, the second question is about the short-term external debt to reserves, and the third question is about the gold reserves and investment practices. Okay, and I will also be making a shorts that you will get at 8 p.m. tomorrow. Now in this shorts you will get more questions, 3 more questions from this particular report, and remember this again, that this report is very, very important. Okay, chalo, this is it for today. Thank you everyone for joining the session. I hope you enjoyed the session, and there are the important points that you have to remember. I will provide you this whole document, and you will get the document in the PDF form. You will get the PDF in the Telegram channel of EduTap, and the link for the Telegram channel is provided in the description box below. Okay then, thank you everyone. Thank you for joining.